Let's do this again. Good morning to all our traders. Okay, we'll do this one live, and let's get the slides up. 1 second, please. Let's try to be cool, calm, and collected about this. And let's show, what can we show? You're seeing the webinar. I think it's screen number 4 cleaned. Hang on. Yeah, now you should see it. Hey, good morning. Good morning, guys. Lots of my traders in here, but also lots of other traders. So we appreciate you coming in on a Monday morning. And we have a very political week ahead of us. Very political week. As we always do, we look at the last trade just before we start looking at the new week. And our last trade was 2 weeks ago. And it was a day trade during the London session. I had come back from vacation, and it always takes me about a week to get the feel back for the market and to feel the nuances of the market. And so this Aussie yen short looked correct at the time, but then it was what we call a scratch trade, just a few pips winning, as you can see here. It's interesting if the market doesn't follow the expected fundamental movement. I call that inherent strength, meaning the market is telling you something about the positioning and about the order flow. If we do not follow the direction. We've seen this last week, the fundamental direction. We've seen that last week during the ECB press conference. We traded that live with my traders, and they saw the whipsawing and the active manipulation by the big boys by withdrawing orders in the order book. And then someone somewhere around the globe presses the button, executes a market sell or a market buy, and that is then filled for that trader at the best opportune limit offer or limit bid. And that's why you can see these vast movements without any volume behind them. So those educators who say fundamental analysis is bogus and you need to watch the order book, they have nada understanding of how actively the order book is manipulated. Next to the fact that you don't see any order book in the OTC market, of which foreign exchange is one. It's an OTC market. Nevertheless, we see the order book in the futures market for the futures contracts in the FX. What are the headlines this morning? We have a risk picture that is mixed. We had Asian equities moving from a bit stronger to a bit softer. Friday over the weekend, Trump had to cave into the Democrats, and they agreed a temporary government reopening, at least until February 15th. In Asia, we saw the Australian equity index close due to a holiday, but then we saw the Nikkei down by 70 basis points due to some yen appreciation. We had one very large Nikkei component coming out with some negative year-end balance sheet information, and that caused the reaction on top. Then we had Shanghai and the Hang Seng red by about 30 basis points. Also due to the fact that the People's Bank of China skipped their OMO, their open market operations, i.e. they did not add any liquidity into the market, and we saw some renminbi appreciation overnight. We also saw a consecutive decline in Chinese industrial profits, which then led to Aussie dollar seeing a little bit of weakness later in the Asian session. This week of importance, obviously Brexit. We have currently two rival factions in Parliament fighting to take control of the Brexit debacle this week. If one side wins, then we may see Brexit probably being paused, and that could entail further pound appreciation. Oops, sorry. There we go. Brexit. I don't even know where it is. Okay, turned the squawk off. I apologize. Happens to me every single morning. Shows how blonde I am. I just can't get it right. If the other faction wins, then we may see Prime Minister May going back to Brussels trying to negotiate the impossible, i.e. the whole backstop debacle with Ireland. In that case, we have some uncertainty reintroduced into the market, and we may see some pound weakness. So We have a saying in Germany that political horses have short legs, meaning whatever it is, be happy to fade the initial move. This week, we have the vote on Tuesday. We also have FOMC this week. We have China-US trade talks, and we have non-farm payrolls on Friday. This is a chart of the dollar renminbi. So you can see we're at a decision point, and hence the bounce, not unexpected, but interested to see where we're heading next, given the US-Sino trade talks in Washington this week. Overnight, here you can see it. We had the antipodons, Kiwi and Aussie stronger, and we did see some weakness in the pound. Obviously, that's normal if we expect further pound appreciation. Today is construction day, Monday. Big boys are getting into position. We would need some manipulation lower in the pound in order to continue the further rally. Risk events, we'll go through the slides. Because of a meeting, I don't have that much time this morning. What do we have for pound and Brexit? So Tuesday, we have the showdown. Actually, that's 1900 GMT, not 10. That's 1900 GMT on Tuesday with voting on a series of potential amendments. And there's 14 amendments, and we'll have to see how that number will fluctuate into Tuesday. And then it obviously depends on which amendment will get enough votes, and that can only happen if certain factions start to collude. The outcome may either direct the government to follow a certain path or taken away the power of steering this entire debacle away from the government and giving it back to the people. My personal assumption from day one, I keep repeating that every single time I get a chance, my personal assumption currently still is that we may see a second referendum and that the UK does not leave. As a currently German taxpayer, that makes me very happy because I have no intention of seeing my taxes rise because of the wealth distribution that's going on within the EU system from the northern states to the southern states. And that is not meant in a derogatory way or any other. It's just a matter of fact. This whole system is wrong because you can't have all these countries functioning under one single interest rate. That is the problem. The only benefactor is the German DAX 30 bosses with their options. EU is unwilling to renegotiate unless the UK is willing to shift its red lines. And then you need to remember that in case May goes back and is asking for concessions, if she hasn't moved any of their red lines, nothing's going to happen. Even if the EU, some party within would like to amend, all nations have to ratify this again. It's a debacle. Most of the possible outcomes, though, this week may lead to the same thing, and that is to postpone Brexit. So on the left-hand side, we see a chart of cable, and I give you a couple of levels where I would be looking for potential long signals. And on the right-hand side, I put back a slide that's 2-3 weeks old, but you can still see some upside targets there with the probabilities at the time. And anything here is 134, 131, 135, and the most recent research by some of the largest banks state 136. On the other hand, we have two very large asset managers in the UK, very, very large asset managers in the UK. Let me repeat this again. Very large asset managers in the UK proponing and stating that they think the pound strength has been overdone. So you can analyze all you want. The fundamentals can do whatever they want. If very large asset managers were to take profits on their longs, the order flow would dictate that the market is coming off. Okay, so that's something we can never really know until we see it. And the volume cannot be hidden. You would eventually see it in the charts. Then we have the euro and the ECB. Thursday, we will have preliminary flash GDP expected. Q-on-Q, a growth in the GDP of the Eurozone of 20 basis points. But you can see here in the year-on-year rate that it's come off. It's only growing at 1.2% annually versus 1.6 last time. So the ECB last week stated that they see the euro area growth outlook as attention on deck, tilted to the downside. And previously, the wording was moving to the downside. So the ECB woke up to the fact that Germany is not growing any longer, that France's yellow vests are costing GDP growth, that Italy's political situation and GDP growth is horrific. We have massive problems. To me, there is no sustained long in the euro. The only way the euro rises is due to dollar strength. Let me repeat this for you. The only way that the euro rises is based on dollar weakness and has nothing to do with fundamental growth within the EU. That whole spiel about raising rates in the Eurozone, we can forget about that. Draghi clearly stated last week that if the market starts pricing in an early 2020 rate hike, currently the market is pricing in a Q4 rate hike, then the market will have understood the ECB correctly. So the market is behind the curve here. Last week, we also saw flash manufacturing PMI coming in at 50.1 versus 51.5, and services PMI coming lower than last time. So economic growth is slowing in the Eurozone. Focus will be to see if Italy entered a technical recession late last year, if Germany has rebounded. Highly unlikely. We did avoid a recession so far, but we'll have to see. Our next GDP growth numbers over here from Germany will be on February 14th. So that'll be of keen interest to us. And then, as I said, what is the impact on economic growth in France from the yellow vest movement? Yesterday, there were 10,000 people on the street, 10,000. Friday CPI will have the flash estimate coming in lower than last time, and the core also low, so that puts additional pressure on the ECB in terms of their policy normalization intentions. You can forget policy normalization, not going to happen, all right? Same in the States, it's not going to happen. What do we have in Canada? Yep, we have Canada, and I love the Canadian long, but I'm coming off of it. Why? Thursday, we'll have GDP growth only expected by RBC to come in at plus 10 basis points versus plus 30 basis points last time. We had Canada Post on strike that detracted some of the GDP growth. And recall, in the States, every week that the government was shut down, that subtracted 10 basis points off of GDP growth. So at 35 or 36 days, you can do the math in your head. And then we had softer wholesale and manufacturing sales reports, down 1% and 0.5% respectively. So while the Bank of Canada is data dependent, and while the market expects one rate hike by potentially June next year, that may get priced out. So we are highly correlated to the movement of oil, and oil is around the 53, and the oil market is waiting for more information. The reason for the oil appreciation last week was that the market was playing Venezuela, but in the end of the day, that's only 2.3% of oil supply in the global markets. Yes, they have the largest proven oil reserves ahead of Saudi Arabia, but then again, the U.S. is getting ready to is already intervening in Venezuela. And there are already the first rumors popping up that they're thinking about a military intervention on top of it. Okay, typical US. By the way, it's the statistically most aggressive nation on earth. RBC's model is currently tracking fourth quarter GDP at 1.1 annualized, but says there are some modest downside risks to that forecast. I included on the right-hand side the economic numbers from last week, and you can see that manufacturing sales and wholesale sales came in worse than expected, and core retail sales as well. So be aware of that. If the oil comes off as well, the Canadian dollar is a short. And by the way, I see nothing this week, nothing fundamentally long out of the G8. It's horrific. It's just everything is red. It's really difficult to find a trade. Everything is red. Okay, and then on the dollar, unfortunately, I didn't finish the slide, but we'll do it verbally. We have China trade talks, 30th and 31st. And my personal opinion is that it's not going to get resolved entirely. I think for the next months, we'll see step by step by step by step, and still strategizing and gaming and back and forth. And, you know, unfortunately, the risk off is not going to be taken off the table this week. Then we had Commerce Secretary Ross. He introduced some volatility into the market last week by stating that both sides are miles and miles apart from getting to a deal. And then we had remarks by Kudlow. He suggested the president was optimistic. Can't even repeat what the president says because he talks like a 6-year-old. It's unbelievable. And then we have the impact seen, especially from the trade war, especially to be seen in the Chinese and the European economic metrics. Europe is really suffering based on this trade war. IMF already last week moved to cut their global growth view for this year. It's looking bleak, guys. Both nations have indicated they will issue statements at the conclusion of the talks. Now, remember last time we had the G20? Some of you may remember that. We had both of them issuing separate statements, and the worst was both statements said different things. So if we have a joint statement, it'll be a risk-on day. If we have separate statements, the market will be keenly focused on what they say individually. If the message is not the same, you'll see risk off. And then Friday, we have non-farm, and that unfortunately will be distorted based on the furloughed workers. So the labor market data, similar to the shutdown that we saw in 2013, is distorted. So you need to be aware of that. We had 800,000 workers drop out of the number. A little bit more than half of them will get their back pay. The other half will not count into the numbers versus counting into the numbers. So it's all distorted. Then in terms of rate hike probabilities, the market is currently pricing in less than 3% probability that the Fed will hike rates this meeting. Obviously, they're not going to. But what's going to be of interest to us is, and this is the verbal part, so you need to pay attention, what is Jay Powell going to say, especially about the balance sheet readjustments? Because running off the balance sheet is detrimental to the risk sentiment right now. And as soon as different Fed speakers came and hit the mic and stated that we'll rethink that, we saw that the risk sentiment changed toward positive. So if you see that the Fed is on pause and switching to data dependent, which they have, on pause in terms of their rate hiking cycle, and if we have more and more statements coming out of the Fed that they may be flexible in terms of their balance sheet rundown, then you will see an equity market being supported for a while. Okay, I don't trust the equity market at all up here. Neither do the pros. What we're seeing is that the market is waiting for new information. And so you need to watch the short end of the yield curve to get that information. It's a little bit of an advanced topic, but it is how it works. All right. Trade this morning. I'm looking for this week to short euro pound, and I'm 100% aware how dangerous this trade is based on political bits and pieces hitting the wire. Nevertheless, euro, weaker economic growth and lower inflation. I want to short anything euro at high prices, and pound, I see potential for deadline extension this week, starting from Tuesday. The problem is, has the pound appreciated already so much that some of the large asset managers, as alluded to early on, will take profits? In that case, this trade may go sideways. So the risk to the trade is better economic numbers in the EU. Yeah, that's as likely as pigs flying through space. That's not going to happen. And or hard Brexit probability uncertainty increases, and then the pound's seen a lot of strength already. So I said that. So let's look at the chart real quick. This is a swing trading trade where I'm looking to short 87.5 area, 400 pips with a stop loss slightly above that. I wouldn't take these numbers exactly like that, but they're a very good indication of where a decision point lies in the market. I like a trade above 88.5 for those of you who trade longer term. At 88.5, I'm seriously looking to short the euro pound because that is an institutional level that may make sense. Currently, anything between 86 and 87 is where the option market indicates decisions need to be made. So, 87.5 down to 86.5 with a stop loss at above 88. Take an odd number. I would explain to you why, but just take it as is if you want. And then we'll see how it goes. High risk trade. because the pound has already gone a long way, and the euro-pound pair is prone for a short squeeze. Last discussion mentioned on my side from this morning within my trading group, we were talking about the strong gold market at the end of last week, and gold is above $1,300, and that's of importance right now to see what the gold market is doing next. One of the reasons was obviously the dollar weakness that crept into the market late Friday afternoon, our time. So keep an eye on that. If the dollar weakness continues, the gold long is still in play. All right. We have a bullish gold market. We have, in terms of the G8, really every single currency indicating red for the coming week. So we may see some risk off if the Brits mess this Brexit scenario up, if US and China can't conclude anything. And if Powell says, just imagine Powell were to say something like detrimental to the risk sentiment, then we have risk off and the gold market may rally. So the decision point in gold is 1,300. See if you can see, given some dollar weakness, a buy signal there. So that's actually three trades for you, 2 in the short euro pound and 1 long gold, if you may. Guys, thank you very much. Little bit slower and more quiet this week. Thank you, Marius. But I was a little last minute. Sorry for not finishing the one slide. I'll see you all next week. Let's make some money. Again, it's going to be a political week. Expect lots of volatility and market manipulation, which means if you get the chance to sit in front of your screen, that's easier money. If you are a swing trader, I would widen your stops a little bit because the big boys will try to get you off the correct trade. Yeah. All right. Thanks a lot. And hopefully I'll see you again next week. Thank you. Bye-bye.
Die Stummschaltung ist aktiviert.